Hey everyone, welcome back to Corporate Decoder. Today, BAYYA just filed an 8K and it signals a 1-month extension on their business combination. But I am seeing a small but important detail that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. They are pushing their deadline back again, and this filing tells us exactly why and what it costs them. So what we have here is a standard form 8K filing. Companies use these to announce major events that shareholders should know about right away. In this case, the big news is about their deadline to complete a business combination. This is Bayview Acquisition Corp, a company that went public with the goal of acquiring or merging with another business. Think of them as a temporary company designed to find a target and then combine with it, essentially taking that target company public. The key date here is the 14th of August 2026. This is when the reported event actually happened. The main event is an extension payment. Companies like this often have a set amount of time, usually around 18 to 24 months, to find a business to merge with. If they do not find one by that deadline, they typically have to dissolve and return money to their shareholders. So on the 14th of August, Bayview Acquisition Corp put $50,000 into their trust account. This money is used to buy more time, specifically 1 extra month. Their deadline was originally the 19th of August, but now they have until the 19th of September to get a deal done. This is what is called an extension. This extension is important because it is the third time they have done this. Their company rules, called Articles of Association, allow them to extend this deadline up to 6 times in total. So they are using up their options, but still have a few more chances if they need them. Now, let us look at what kind of securities this company has. This section lists the different types of shares and rights they have registered with the stock exchange. They have something called units. Each unit is made up of one ordinary share, which is a basic share of ownership and one right. Then they have their ordinary shares themselves, with a very tiny face value of $0.0001 per share. And finally, they have rights. These rights give the holder the ability to buy a fraction, 1/10 of an ordinary share. It is like a voucher for future shares. The company has checked the box indicating they are an emerging growth company. This means they are a newer, smaller public company and can take advantage of certain relaxed reporting rules. It is a common status for companies like this that are still in their early stages. They have not elected to use the extended transition period for new accounting standards. This essentially means they will follow the newer, stricter accounting rules as they come out, rather than getting extra time. Now, let us talk about the financials, or in this case, the lack of traditional financials in this specific filing. This 8K is purely about the deadline extension and the cost associated with it. There are no revenue numbers, profit and loss statements or balance sheets here. We have to look at other filings for that. What this filing does tell us is that Bayview Acquisition Corp is still actively searching for a business to merge with. The $50,000 payment is the price they are willing to pay for this extra month. This is a common practice for special purpose acquisition companies or SPACs to buy more time. Consider this like paying rent for an extra month to find a house. The company is paying that $50,000 to avoid having to return all the money raised to its investors. Historically, many SPACs struggle to find suitable merger partners within their initial deadlines. When they do extend, it often means the search is proving difficult. We have seen many SPACs eventually fail to complete a merger, leading to the dissolution of the company and the return of capital. For example, companies that have gone through multiple extensions sometimes signal a challenging search environment. And it is not uncommon for about half of smaller SPACs to end up not completing a deal. The critical part here is that they are burning cash to buy time. While $50,000 might seem like a lot to an individual, for a company that has raised millions to find a merger, it is a cost of doing business. It buys them breathing room. The biggest question remains: what are they trying to buy time for? Are they close to a deal, or are they just delaying the inevitable? This extension does not provide any clues about the quality or nature of any potential merger target. Looking ahead, the next key date to watch will be the 19th of September. If they announce a merger agreement by then, this extension will have served its purpose. If not, they will likely need to make another extension payment, assuming they have more of those permitted extensions available. So, while this filing is short on financial detail, it is rich with information about the SEAC's operational status and its continued efforts to execute its business plan. The company is alive and kicking, but still searching for its purpose. My take on this filing is that it is a routine procedural step for a SPAC. The $50,000 payment is a small price to pay for an additional month of runway. However, the fact that they need a third extension suggests the merger search is not straightforward. The key risk I am watching is simply the passage of time. If they continue to burn through their extension options without a deal, the likelihood of a successful merger decreases. What I am actually looking for is any news or filing indicating they have identified a merger partner. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this helpful, like, subscribe, and join our Discord community.